Good morning from London. I'm Anna Edwards alongside Kriti Gupta and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. The European earnings season rolls on with NatWest and Man Group among the heavyweights reporting this hour. We'll bring you those numbers crossing the terminal. Earnings plummet at Mercedes, the German car maker, the latest to report slowing sales of EVs and weaker demand in China. But Hermes bags a sales beat, bucking the slowdown in the luxury sector. Plus, we preview today's key reading on US inflation as investors warm to the idea of faster rate cuts from the Fed.
In the meantime, a quick check on those markets. You're seeing green on the screen over on the other side of the Atlantic, but green on the screen here as well. Eurostar 50 futures kind of virtually unchanged. Slight outperformance in FTSE 100. I wonder how much of that optimism we're going to get off of yesterday's action, but you're also seeing slight strength, emphasis on slight in some of the currencies. 108.56 on euro dollar, 128.62 on cable. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. Just gone 7 o'clock here in London this Friday morning. It has been a busy week for earnings, a busy week for shifting expectations around the tech sector, a busy week for shifting expectations around the Fed as well, perhaps. We will sound the drumbeat to the PCE data due out later on today. In the meantime, let's get on with some earnings stories. And we have NatWest just breaking this morning. Net interest income coming in at £2.76 billion. That's a little ahead of the estimate. The pre-tax operating profit well ahead of the estimate. Net income also well ahead of the estimate. We are looking to see, I was just going to say, if they increase guidance, and there we go. NatWest Group increases full-year income guidance. That was one of the things we were looking out for today, as well as any guidance around buybacks and the higher-for-longer environment, what that does to expectations around profitability. So there we are. NatWest numbers out this morning.
Yeah, especially interesting given our top scoop from our political correspondent Ellen Milligan yesterday that UK Chancellor Rachel Reeves is leaning towards offloading a substantial portion of the government estate in NatWest to institutional investors rather than to the public, as Jeremy Hunt, the former Chancellor, had been planning. But as you say, that full-year guidance is especially interesting in the context of the BOE's more cautious approach to rate cuts as well.
You know, it's interesting. I think for our international audience, we need to put this into context here. The government owns about 20%, just shy of 20% of NatWest shares as well. And this is all part of this idea that they are going to kind of help and reinvigorate the UK capital markets, that they're going to be helping with some of those potential moves to making those kind of pension investments more attractive as well. Yeah. Is this that first step to doing it?
Yes, and looking like they're going down that institutional route, as Lizzie was saying, rather than the retail investors. Let's talk about Man Group, also getting numbers from the listed hedge fund business. Assets under management coming in just ahead of the estimate, it would seem, from what I'm looking at here on the Bloomberg terminal. So $178.2 billion in assets under management is the number I have in front of me. First half net inflows of $900 million. So that also looks to be coming in ahead of estimates. Those are the numbers we have so far coming through on Man Group. As always, it's a conversation about flows. It might turn into a conversation about M&A as well. And also interesting to always get a sense of what the client conversations look like. What are the strategies that are popular that seem to be paying off at this point?
Yeah, it's interesting. And you mentioned it's all about the flows here. And just as you were speaking, the net income flows actually came out as well. You're looking at something like $900 million. The estimate there was just about $647 million. So there's a lot going on there when we're talking about those flows. And we're, of course, going to discuss that shortly with the CFO of the company.
So those are the breaking earnings. We also, before market, had Mercedes. Of course, it's been a pretty of a bleak week for the autos industry, but we had these numbers from Mercedes saying that earnings plummeted 28% in the second quarter because of the theme that's been throughout the week, EV sales dropping and China demand weakening as well.
And China demand weighing there. China weakness in luxury has been a theme, perhaps not so much for Hermes. At least in the US, they're benefiting from a flight to quality. So Hermes really broadly bucking the trend of negativity around luxury stocks. They are talking about softer traffic with aspirational customers, and so that does seem to be something that taps into some of the other luxury stories, but that's not their area of focus. We will talk more luxury as we go through the programme.
We absolutely will, especially in the context of broad thing. Our Birkin bags, kind of this inflation-proof item that it seems everyone's getting. They're saying it's more valuable than gold when you talk about the investment. It seems like Hermes
doesn't have a ticker yet. We must create one.
We're
this market needs visibility.
I'm sure sure Bloomberg data is on it, right? There absolutely are. But speaking of that kind of broader story, let's talk about what we can expect in the U.S. session. It is all about what the Fed is going to be pricing, and PCE is going to be really crucial to that piece of data. We are expecting another slowdown, going from 2.6% to about 2.4% reading. And I think this is a really interesting moment because, of course, this is the Fed's preferred inflation gauge. But our producer, Dan Curtis, was pointing out, if you look at this chart here, that the estimates that are baked into this market right now point to a U.S. core PCE annualizing at that really crucial 2% level. That is exactly what the Fed wants to look for. So if they come bang in line with estimates, Anna, that is exactly perhaps a positive for the Federal Reserve and a positive for some of that cut pricing.
Yeah, so this is going to be crucial, isn't it, Lizzie, this PCE data we're looking at. But it comes on hot on the heels of the GDP print yesterday, which came at a time when the market was thinking, OK, it's starting to look like we're going to need some more cuts, and certain former Fed voices, at least, were making headlines saying we're going to need some more cuts. And then you get this better-than-expected GDP data, made everyone scratch their heads for a moment and say, oh, hang on, what are our Fed expectations now?
Interesting to hear from Mohamed El-Erian yesterday warning that too long a delay on cuts could prove a policy mistake. So interesting, strong commentary from him. But, yeah, we look ahead to that PCE data, of course, the preferred inflation gauge for the Fed.
Absolutely. Right, that's the macro and some of the earnings stories. Let's circle back to one of the earnings stories that we just talked about there, and that is the hedge fund Man Group, reporting numbers this morning then. The CFO joining us this morning, Antoine Forterre. Very nice to see you, Antoine. Thank you very much for being with us on set this morning. So let's start with the flows. First half net inflows, $900 million, looks to be above what the market was expecting, looking for there. What is the flow story? Where is that coming from? Is this institutions in the US, Asia? Is it high net worth individuals? Where's the money coming from at this point?
So thank you for having me. Good morning. We had a good set of results, $900 million of net inflows, which is just shy of 2% ahead of peers on an asset-weighted basis. So we're gaining market share, continue to gain market share. And we've seen demand from institutions in liquid alternative, areas like risk parity, areas like risk premia, as well as credit. Credit has been a big theme for us, for the industry at large. Our discretionary credit teams have done very well from a performance point of view, and we're seeing good flows in that category as well.
OK, and we'll talk about that in a moment, actually, perhaps, because I know that you've bought businesses in credit in the past, and maybe that's an area of expansion. Clearly, you're mentioning it as a highlight this time. Just want to stick with the flows story more broadly, though, and get a sense of where the outlook is, because that's the sort of backward-looking story, where that money has come from. What does the rest of the year look like? What do client conversations sort of suggest the rest of the year will look like?
So positioning is still positive. People are looking for diversifying content, so liquid alternative in particular. What we're seeing, however, is institutional clients in particular, waiting for private equity realizations to come through. And as a theme, that's sort of blocking certain institutions to allocate. But if you look at our pipeline remains strong. Client discussions very positive across the board. And we're seeing also renewed appetite in wealth. Some of our initiatives in wealth, we signed a partnership.
So just for clarity, that's waiting for PE transactions to take place,
Correct.
To free up some money,
Correct.
and then you expect some of those
Correct.
flows to come your way.
Yeah.
OK, interesting.
Well, let's apply the currency lens to all of that here, because when we're talking about those flows, $900 million, I believe, was the increased flows in terms of the numbers that hit the terminal. 647 was the estimate. How does the strength you're seeing in the pound affect your bottom line? How long do you expect that to sustain?
So we run assets on our P&L in US dollar. Around 40% of our AUM is in non-sterling, non-dollar currencies, so we get the benefit there. Although on the cost side, in our P&L, around 60% of our fixed costs are in sterling in particular. So actually, we're naturally quite hedged, which means that we take the movements of currencies as they happen when it comes to your P&L. Obviously, volatility in markets, dispersion in markets is a positive for our strategy to be able to generate return.
Yeah.
And so we welcome that sort of volatility and dispersion in different currencies and interest rate cycles, which we haven't seen for a long time.
And I'm curious then, from just your macroeconomic lens, then, if we can broaden out the conversation, how you're viewing this currency market. I think there's been a lot of questions right now about, in a very low volatility FX market, the pound is outperforming. Some are calling it a labor government honeymoon. How do you feel about that?
We feel so. Volatility dispersion is good for us, good for alpha generation. And what we've seen over the last year and a half now is macroeconomic cycles differing between countries in ways that we hadn't seen for 10 plus years. All that is positive. When it comes to the UK, the sort of political stability that we're seeing now and the pro-CT stance that we're hearing from government is positive, and so we welcome that as much as possible.
And are you looking at any acquisitions?
M&A is a key part of our strategy. We, as Anna said, acquired a business last year called Varigan in private credit in the US. Credit being a key focus for us, if we do find targets that meet some of our criteria, we would consider them. But we remain very disciplined. We've been very disciplined for a long time, and that hasn't changed.
On that subject, though, do you see much more opportunity in credit? You talked about it as a bit of a highlight. You've done some deals there. Might we see more deals in credit? Is there still opportunity as banks retrench, perhaps?
There's been a few. There's been a few this year, and we've looked at a few this year, but our discipline hasn't changed. And the focus for us is making sure that we allocate our capital in most efficient way for shareholders. And so we're not going to rush and join the flurry of acquisition just because.
Well, are there any gaps in the product line that you want to fill?
Organically, we're looking at quant equity, big area of focus for us across the more hedge fund content. So think of it as sort of equity startup, mid-frequency equity, as well as more kind of scalable alpha, particularly for wealth channels in the US. Credit, we talked about, big area of focus for us. We have around $30 billion now of credit in the mix. And here we're looking organically and inorganically to add teams. And then, broadly speaking, solutions, anything that enriches the dialogue we can have with clients is something that is interest to us, mostly organically.
That's a lot of areas of the market to be looking at. This sounds like a very acquisitive business, Antoine.
Not all through acquisition, to be clear, organically and acquisition.
A mix of the two.
Exactly. And we've had great successes organically in the last 10 years, and we'll continue there.
But in that dialogue, where do the conversation of passive investing or ETFs or mutual funds show up? And I ask this in the context of the UK. It feels like almost catching up to the United States when it comes to offering that kind of product, especially now when we're talking about things like pension investment, et cetera. How does that show up in the broader markets for a player like yourself?
Passive is a theme, and it's a theme that's been around for 10, 15 years, and we have a book of long-only asset in particular, which has been exposed to some of those strands and remain exposed to some of those strands. The ETF evolution is an interesting one because now you see the growth of active ETF, certainly in the US and more also here in Europe. And we've launched over the last year a few active ETFs in partnership with platforms in the US, and we're seeing good flows there. And so it's interesting that we seem to have gone full circle with the technology that enabled passive to then go back to active as a way to gain market share with institutions. So we're positive there, in particular when it comes to wealth channels in the US.
So the buzzword, I feel like, on the side of the Atlantic is a lack of risk-taking culture, that it needs a shot in the arm. And you hear this over again from government officials to the top players in UK banks as well. I'm curious how that shows up. You're talking about you have these active ETF kind of products. They're getting good reception. Are they getting enough reception, though, to get it to the point where in the next, say, 5 years, you could see it actively going toe-to-toe with flows into the States?
I think passive has a room to play in portfolios. It's not one in which we participate. In the UK as well, US and UK. But ultimately, if you want excess return, outperformance, it can only come from active management. And this is where we're positioned. We're a global leading firm in active asset management, in alternative asset management. And that's firmly where we positioned ourselves, trying to add diversifying content to portfolios, institutional and wealth, globally.
Antoine, we've had a very volatile political backdrop in the UK for some 8 years or so, and now we have a new government in place. And I wonder how that rubs up against a business like Man Group. What are you watching for? Do you focus on sort of tax policy or a resurgence in the City of London? What messaging are you putting out there in terms of priorities?
We're absolutely apolitical, and as I alluded to before, we welcome stability. I think having the UK feel more normal, investable is a net positive. And the current government has been very pro-city, at least in their external communication over the last really year now, with changes coming through and changes being mooted, and the willingness to engage with the city, which is positive. So we're very welcoming of the pro-business, pro-city stance that we hear. If it makes the UK more investable, so be it. We're fortunate to be listed here, having been listed here, but we're really a global business where, as I said, we're the global leader in our space. We happen to be listed here, which is something that people should remember.
Not considering being listed elsewhere.
No.
Okay, thank you.
Well, let's see how long that Labour honeymoon continues. Man Group CFO Antoine Forterre, lovely to have you with us in the studio.
Thank you, Lizzie.
Coming up on the programme, it's another big day for guests. Holcim CEO joins us at 7:30 a.m. on the company's latest results. We're also going to hit the macro picture with Rabobank's Jane Foley and Pictet's Maria Vassilou. We'll also hear from the CEO of one of the Olympics' big sponsors, Danone. That's ahead of the opening ceremony in Paris. Later on, we're also going to check in on how Mercedes and Hermes are faring at the Open, with both autos and luxury, of course, causing concern this quarter. But up next, the co-CEO of Vontobel on the asset manager's latest earnings report. And if you've got any questions of your own for our guests, do please send them in on IB plus BBTV Go. This is Bloomberg.
Welcome back, 7:18 here in London. We've had a lot of earnings to deal with this morning. This is the futures picture right now. Looks slightly positive across broader markets. We will see how that transpires, how that comes to pass in 40 minutes' time. Let me just correct something that was said earlier on in the network. We've been covering the Mercedes numbers this morning, and I just wanted to make the point that earlier on we said that their earnings fell by 28%. It was, in fact, a fall of 19%. So just to make that clear on the auto sector this morning.
Well, let's go from autos right back to the financials. You just had a very interesting conversation on client flows with Man Group. Let's continue the conversation with Zurich-based Vontobel, which reported first-half earnings, assets under management coming in just above 225 billion Swiss francs. Joining us now, I'm glad to say, Christelle Rondeau-Lint, co-CEO and head of investments over at Vontobel. Christelle, a pleasure to have you on the program. Let's just dive into this flow story. Walk us through where the bulk is coming from.
Yeah, absolutely. So, look, I mean, we're pleased with the results for this first half of the year. Our profitability is up 12%. Net new money is positive at 2.3 billion. That is driven by a strong continued momentum on our private client business and a halting of the outflows on the institutional client business, which is a good result amidst an industry that continues to see outflows for active managers. And we've kept our rock-solid balance sheet with a quarter one ratio of 18.3%. So strong start to the year.
Do you feel in your conversations with clients right now that even though it is a strong start to the year, there's maybe just a little bit of caution there? How much of that money, how much of that fund flow do you still see able to be deployed in the second half, given the geopolitical risk on both sides of the Atlantic that we're facing?
Well, I think the clients have been warming up, and we're very well placed to see actually the divergence, knowing that our business is really very much half, when you look at our assets under management, half with private clients and the other half with institutional clients. The private clients tend to be more steady, let's say. Institutional clients, the flows are way more cyclical, and you can see that there's a re-engagement. But again, it's been reasonably timid. Has started mostly with fixed income, which was in line with our expectation and one where we could really seize the flows. But yes, there is a case for more engagement, I think, going forward. In particular, as the Fed starts cutting rate against a backdrop that remains resilient.
Okay, and that's interesting. That's your expectation. Let me ask you about how you manage the business in terms of headcount and hiring strategies, then, Christelle, because I think that perhaps hiring has slowed down recently. You're in a bit of restructuring mode. Where are you planning to hire staff, though? Are there areas of the business that you are still building up?
Look, we have last year really engaged in a one-off accelerated, if you want, strategic hiring, in particular on the distribution to private clients. So an accelerated hiring of relationship manager with a net hiring of 42. We're going to go back to a rhythm that was more common to what we had in the last few years. And we are indeed in an efficiency program where we are aiming to take out a gross cost of 100 million by the end of 2026. We're on track for that. And that is precisely actually to be able to retain that flexibility, to seize initiative, to continue to grow, and to go in the segment where we do see growth. And by the way, that can also be inorganically And we're very pleased that we've closed the transaction with Ancala that brings us private market capabilities in the infrastructure segment.
Yes, I wanted to ask about that. You bought that stake in the UK private infrastructure firm Ancala that you referenced. Where is the opportunity then, or how big is the opportunity around infrastructure in the UK, but also more broadly around Europe? Many investable themes in that space.
Yeah, absolutely. I mean, we view the opportunities as being very large. I mean, private market obviously has enjoyed quite a strong growth. Infrastructure is slated to be the fastest growing areas for an obvious reason. We have infrastructure needs, whether it's through the transformation, digital, as well as towards more sustainability. And we see really governments leaning into that infrastructure development, certainly in the US, to be seen how that continues, but everywhere. So definitely from a macro perspective, a strong tailwind there, but also from an investor's perspective, you know, infrastructure has this really decorrelated risk-return characteristic. You can have lower volatility. And Ancala precisely really brings its value added through the management of the underlying assets. So a very attractive space.
To be clear, Christelle, is the US still your priority market?
The US remains our priority market, or one of, I shall say, and we've really also expanded there in the sense that we closed our acquisition of UBS SFA last year, which makes us the largest player for US Nexus clients who want to be booked in Switzerland. And we've also, since last year, we are in a position to bring all of our investment capabilities to the US, which wasn't the case up until then. So, so definitely a focus area for us, yes.
So, Christelle, where, though, in the States? If you're talking about the equity market, the bond market, arguably the dollar, wherever you go in terms of American assets, the conversation is overvalued, oversaturated, crowded trade. How is Vontobel facing that?
Well, I mean, it's, you know, the US is where it's a distribution market, if you wish. That doesn't mean that you necessarily invest in the US, though I'm not making a call in particular in the US equity markets, but there are very many space, right? Infrastructure, we just spoke about Ancala. Ancala can also obviously be distributed to US clients, and no doubt that those clients will also have a keen eye on infrastructure development and the type of risk return that it can bring to their portfolios. But fixed income as well, and that is broader than US fixed income, can be global fixed income across segments.
Christelle, you mentioned when I asked you about hiring, you talked about increasing the number of relationship managers. And I wonder, in terms of the wealth management side of the business, geographically, where is most of interest?
So our focus is really on developed market. That's part of our strategy. It also is driven by the fact that really the business model, one that we believe in very strongly, is squarely investment-led, as opposed to being credit-led. And some of the markets, say, where we don't cover wealth, and in particular in Asia, you have a need for being more credit-led, which is one where we don't see it fit with our own business model. So the growth areas, the focus areas for us are really in the developed markets.
Okay, really interesting. Christelle Rondeau-Delint, co-CEO and head of investments at Vontobel. We could have spent a lot longer with you. It was lovely to catch up with you. We thank you. We're going to keep talking about the growth of infrastructure and building with Holcim, increasing its profit margin guidance on strong construction activity. We'll speak to the CEO of Swiss building materials company next on the programme. So stay with us. This is Bloomberg.
30 minutes from the start of the opening trade. Let's have a look at some of the markets and how we are positioned then going into Friday's session. We're increasingly thinking about the Fed and, well, continuing to think about the Fed, and that's led us on some twists and turns this week in terms of expectations. Stocks look as if they will be a little firmer this morning. European stock futures are higher. US futures are higher. We got good data on GDP, which caused everyone a pause for thought yesterday in those markets over in the United States. We move on to PCE data due later on today. All that in keeping bond markets perhaps in limbo just a little this morning. We're pretty flat on the US 2-year. We do see a little move upwards in the yield on the 10 and the 30-year over in the United States. And that is the picture across European equity markets, where we see some selling and some bond yields a little bit higher, in fact. Let's get more on the earnings stories, though. Holcim has increased its profit margin guidance as the Swiss building materials giant benefited from strong construction activity across all regions. Let us get into a conversation about this industry. We're joined by Miljan Gutovic, who is the CEO of Holcim. Very nice to have you with us, Miljan. Let me start with the guidance story then. So you've upgraded your guidance. Where's the confidence coming from? What is it that's proving to benefit your business?
First of all, great to be here and thanks for having me. Holcim achieved record profitable growth in H1. Our EBIT is up 12.7% in local currencies, double-digit growth in earnings per share, and especially we are proud on our margin expansion. Margin increase in Q2 by 210 basis points. With all these financial results, I should say excellent financial results, we are confident to upgrade our EBIT margin from 18% to above 18.5%.
Yes, so you've upgraded the guidance, and I wonder, because some people had expected you to do that because they thought that perhaps cost actions that you're taking or the ability to manage cost a little more easily in a lower inflation environment might offset a little bit weaker demand due to wet weather. Tell me about the dynamics that have come into play.
Well, this is driven by our disciplined execution of our strategic priorities. We are delivering profitable growth across all our markets. We are leading our sustainable building solutions, delivering superior value to our customers. Decarbonization and circularity are profitable growth drivers for us. And we are continuing with our highly value accretive M&A execution with another 11 acquisitions just in H1 on top of 28 we did last year.
I'm especially interested in the demand for the construction of data centres that you're seeing. Where is that demand coming from? Is it more the US or Europe? And how much more money are you set to get from that construction demand?
This is one of our most attractive projects. We have 90 projects in the pipeline. We are working from Amazon to Meta to deliver sustainable advanced solutions, from our latest low-carbon concrete EcoPact to our advanced roofing systems, Elevate and Duralast. Out of 90 of these data centers that will be built in the next 4 years, half is in US and the rest will be in Europe and Australia.
And you mentioned Amazon. I know it's been a big customer of yours asking for that sustainable construction. How is the kind of demand changing from that kind of customer in terms of what they're asking for?
Customers are demanding sustainable building products. They are pushing us to create new and innovative products with reduced CO2 footprint. And Holcim is well positioned to capture these opportunities. We have our EcoPact low-carbon concrete, which today represents 28% of the total sales in our ready-mix business.
So walk us through some of the kind of numbers around this then. It feels like as we have that European expansion, you're going to need quite a bit of CapEx right off the get-go. I believe some reporting that you plan to invest about 2 billion Swiss francs there. How much more do you need to invest to kind of solidify some of that demand over the next, say, 5-10 years?
Well, in Europe, we see decarbonization and circularity as a profitable growth opportunities. We are constantly scaling up our initiatives in decarbonization and circularity. Yes, we do have a well-established CapEx pipeline, but most of these projects have been partially funded by European Union. Therefore, we have high return on investments and very attractive paybacks.
Interesting that you talk about partially funded by the European Union, because I'm curious then about some of those infrastructure investments that you might get from the States as well. We know that a lot of this kind of greener plans has been largely funded by the States as well and by the Biden administration. How are you thinking about the next 6 months in terms of some of that aid you might get not only in Europe but in the States as well?
Well, for example, Europe has the most advanced decarbonization framework in place. And this framework includes funding of the projects for companies like Holcim to accelerate decarbonization. And the same we are seeing in US. We are working on several big-size projects that will help us reduce the CO2 footprint.
Can I ask about the balance of your businesses, Miljan? Because, of course, you make a whole range of building materials. You do make cement, but it's less than 50% of sales, I think, from your 2023 annual report now. And you are growing in that solutions and products area from 9% in 2018 up to 21% in 2023. How big can that part of the business get? Because you've emphasized it in this conversation, but how big can it be?
Well, sky's the limit. We are constantly investing not only in cement and ready mix, but as you said it rightly, in our solutions and products range. Just for example, our roofing business has reached 4 billion last year. We started this business 3 years ago. We went through the massive M&A acquisition. We buying Elevate, which is today the third biggest commercial roofing company in US.
So we've talked a lot about the demand story, Holcim, but I wonder how much you're having input cost deflation to offset the kind of difficulties, perhaps, that you may see on the demand side.
So when it comes, we are constantly striving to improve our operational efficiency, and we are constantly exercising strict cost discipline. But when it comes to cost, I'm never happy. Cost is there to be reduced, and we have ongoing initiatives to improve operational efficiencies and also to reduce the cost.
Talk to us a little bit about the China business as well. We keep hearing in terms of raw materials, in terms of the demand story, even in terms of demand for luxury products, which I'm sure you're an expert of, Miljan. You are starting to see that weakness around the world. How does the China weakness show up in Holcim's numbers, and how are you perhaps hedging against that ongoing weakness that's largely expected?
Well, China has been soft in the last few years, but our presence in China is not so big. Therefore, impact on Holcim is negligible. Our biggest market in Asia is Australia, and here we are seeing a nice growth. Australia is growing, infrastructure projects are there, and also the government spend is going to be significant in the next few years.
Miljan, we've talked a lot about some of the structural factors that have been driving demand, data centres, a big shift to electrification of the global economy. This is a structural driver for construction and building materials. I wonder cyclically what your expectations look like, because we are sitting at a, relative to recent history, higher level of interest rates, which can weigh on construction and has in some places, but there is an expectation we get rate cuts soon. How do you look at the cyclical outlook ahead?
So fundamentals are very strong. Construction industry will continue to grow. Governments will continue to invest in infrastructure. Population growth, urbanization will drive residential and commercial buildings. And also, we want to build a more sustainable world. So I believe that we have strong fundamentals in the years to come.
All right, Holcim CEO Miljan Gutovic, lovely to have you with us. We had get your earnings this morning, raising the profit margin guidance but trimming your sales outlook. Lovely to have you. Coming up, stocks to watch, including Hermes, the French fashion house and Birkin bag maker, bucking the luxury downturn with a sales beat. We'll have more on that next. This is Bloomberg. We are about 17 minutes from the opening trade here in London. Futures pointing higher on the Eurostar 50, about 0.25%. But let's take you to an update on US politics. Kamala Harris saying that she pressed Israeli Prime Minister Benjamin Netanyahu to accept a ceasefire and warned him about the death toll in Gaza. The comments suggesting a possible departure from Biden's approach to the situation in the Middle East. And we can get more now from Bloomberg's Vonnie Quinn, who's been following all the action from Washington. Vonnie, what are the key takeaways for you from Netanyahu from this meeting with Kamala Harris?
Well, it was a huge meeting, Lizzie, wasn't it? I mean, it was the second day of her campaign, the first time she had met a foreign leader as now the nominee for President of the United States. And there were public remarks in which even her body language expressed the fact that she doesn't know this man. She hasn't got a 40-year relationship with him like Joe Biden has. And she definitely deviated from the Biden position, which is a sign that she's finding her own voice in foreign policy. And what else might she deviate on? She talked the same game when it came to Israel being allowed to defend itself and the US supporting that. But she also made a caveat. She said, you know, it matters how you defend yourself. And she spoke directly to those who are protesting and demanding a ceasefire. She said, I see you and I hear you. She spoke at length as well about the humanitarian plight in Gaza. It is worth remembering that there is a political incentive for her to speak this way as well, right? President Biden has alienated certain parts of the electorate over the last 10 months by his unwavering support of Israel and its war on Hamas. We've seen university sit-ins, we've seen police called to disperse those sit-ins and to arrest protesters in some cases. There were massive protests in Washington, D.C. this week, thanks to the arrival and the speech to both houses of Congress of Netanyahu. So with this kind of approach, it is also possible that Kamala Harris will ally herself with certain parts of the electorate that perhaps had decided maybe not to vote for President Biden or at all this time round.
Well, Vonnie, and it's fascinating as well. I think Dearborn, Michigan, which is, of course, a city with the largest Muslim population, really showing testament to that point that we were just making. But in that kind of conversation, you're also hearing comments from President Trump's side as well, the campaign coming out of the GOP, especially around debate season, where I imagine the foreign policy conversation that you just laid out will be one of top on the agenda. Walk us through the developments on the debate story.
Yes, there have been a few, Kriti, and just to point out that later on today, Friday afternoon, Netanyahu will meet with Trump at Mar-a-Lago, and it will be very interesting to see the rhetoric that comes out of that meeting because, of course, Trump bears a grudge. He feels like he did a lot for Netanyahu and for Israel, and Netanyahu betrayed him when he congratulated Joe Biden on winning the last election. But to your point, we have had some developments because earlier in the week, as we know, Trump welcomed more than one debate. He wanted perhaps 2 or even 3 debates against Kamala Harris. That was on a call that he held with reporters. Just a few hours ago, Kamala Harris said, let's go. They were her very words coming off that plane from Texas where she had been campaigning. She said she wanted the electorate to see the split screen. She was quite happy to debate Donald Trump. And then in the evening time, in local time US on Thursday evening, the Trump campaign came out and said, look, the Democrats are in chaos. They don't know who's going to be the nominee. It could all change again, and we are not committing to anything before we know exactly who formally is going to be the candidate. So as Kamala Harris used the word backpedaling earlier, so it came to pass. It did seem like the Trump campaign was backpedaling. And it is just one more sign that the campaign is resetting and is continuing to try to deal with what is now a new set of challenges in front of it. Not Biden anymore, but Kamala Harris, a rejuvenated Kamala Harris and her campaign.
Vonnie, thanks very much. Bloomberg's Vonnie Quinn with the latest on the political stories emanating from Washington, D.C. and the latest in the run-up to November's election. Let's pivot to our market conversation then now. Markets watching the developments, of course, in US politics very closely. For the moment, though, the futures picture in Europe looks like we might see muted gains at the start of trade. US futures look a little more positive than they have done earlier on in the week. Let's talk about these markets in a few minutes. Rachel Evans joins us, Bloomberg's managing editor for FX and rates across the US and EMEA. Rachel, good morning. Let's start with the Treasuries conversation then, because we touched on this yesterday a little bit. Former Fed officials weighing in, expectations rising of an earlier cut in rates, but Then we got that GDP data. How have Treasury markets been coping with all these mixed signals?
They've been quite volatile, I think it would be fair to say. I mean, certainly yesterday we saw a little bit of maybe the market getting a bit ahead of itself. We were seeing a really big rally in Treasuries, particularly in European hours, as folk kind of processed some of those comments from Dudley about the prospect of maybe cutting as soon as this month, and then kind of like moved on to look at Mohamed El-Erian's comments, where basically he was saying that if the Fed doesn't get on with it, it risks having kind of a policy mistake. So that really kind of got everyone jazzed up and buying Treasuries on the expectation that maybe there could be a cut coming, something that the swap market really hasn't been pricing. But then we saw that really kind of paring back as GDP data came out, and it showed that the economy is in actually really good nick. It's been growing very, very healthily indeed. So that kind of gives a little bit more wiggle room for the Fed when it meets next week to kind of consider the full picture of data and decide whether now is the right time to cut or whether they would like to see a little bit more of a development. So there's this real kind of interesting battle, and I think the market is going to continue to be very volatile, particularly around PCE data that we obviously have later out today that will give the Fed its kind of last read on inflation and whether prices are heading in the right direction.
Rachel, can I skip ahead to the Japanese yen? Because your team put out a fabulous piece about how this is affecting money flows and the fact that you are seeing such yen appreciation lately that's kind of shaking up portfolios around the world. Walk us through what's going on in Japan and the positioning around the yen.
Yeah, no, I think that's been an absolutely fascinating story. Just the stretched positioning in the yen has really been kind of a thing that's been a function of currency markets all year. We've been seeing shorts growing week in, week out, and suddenly they've all decided to rush for the exits at the same time. So you've been seeing a lot of these sort of carry trades being liquidated. I mean, we saw the impact through to other markets very, very clearly yesterday with how kind of the Chinese yuan reacted. We were seeing the yuan, which has been another carry trade sort of target, a funding currency, also kind of like gaining in the same way that the yen was gaining. But I think the yen is going to be very interesting over the next few days because, we really saw how fragile that rally can be. Yen was up at 1.1% yesterday and then reversed completely in US hours following that GDP data. So a lot is going to come down to the Bank of Japan meeting next week and the Fed meeting next week. Yeah. At the moment, we have about a 70% chance of a BOJ hike next week. Now, there's been some speculation that because the yen has rallied so much, that the BOJ will feel less compelled, less pushed to actually go ahead and start raising rates again. But if they do that, then I think you could see that kind of rally in the yen reverse very, very quickly indeed.
Just briefly, we've got some volatility back in equity markets, courtesy of disappointing earnings news.
Yeah, the VIX has really been on a tear. It's sort of risen to the highest since April, and it's within a whisker of the levels it last reached in October. The issue is going to be whether it can it keeps on going or whether actually we see some of the earnings stabilise and volatility start to head back.
Rachel, thank you so much for your analysis. Rachel Evans, Bloomberg's managing editor for FX and rates across the US and EMEA.
All right, let's get our stocks to watch with Lizzie Burden. Lizzie.
Well, I'm glad you ended on the earnings picture there, Kriti, because that is the theme for stocks to watch this morning, starting with Hermes. We had their results, and the Birkin maker is actually weathering this storm in luxury better than its peers because, of course, it targets the wealthiest of clients, and they still want their Birkins. But they are not managing to escape the weakness in China that, of course, has been a theme throughout earnings this week. You can see here how Hermes is clinging on to its gains year-to-date better than its luxury rivals. But if we take a look at Mercedes as well, it picks up on this theme of China. China, its biggest market, actually. And the car maker saw earnings plummet 19% in the second quarter because of that dependence on China and because of another theme of the week, EV sales. And so they're on the back foot. Out of Europe, really, it's only BMW that has been managing to buck the EV trend. But you can see a difficult year for the autos industry. We had the Stellantis CEO yesterday saying that it's very much in turmoil. And you can also see how it compares to the other car makers there. Just flipping over to NatWest, because we also had results from them at the top of the hour, boosting its forecast for full-year revenue after net interest income dropped less than analysts expected in the second quarter. Those shares, you can see here, up 39% so far this year, and it's been outperforming its peers in banking as well. Be interesting to see how the market takes our scoop from our very own Ellen Milligan last night, that actually the UK Chancellor Rachel Reeves, the new Labour Chancellor, is leaning towards offloading a substantial portion of NatWest actually to institutional investors rather than to the public. So we'll keep an eye on all of those three stocks to watch at the open.
OK, Lizzie with a rundown there of the stocks to watch. Kriti will keep an eye on all of those. Also, BASF could be in focus. A slight drop in profits, slightly below estimates, a real sense of bouncing along the bottom on German manufacturing. Yeah. The broader picture in markets, we're working our way towards the PCE data later on today.
We really are. And look, this is coming at a time when you still have 2 Fed cuts priced into this market. And a lot of people are saying, well, look, some of this is weakness that we're seeing in Europe. Of course, the manufacturing sector, you brought up the weakness in China that Lizzie was just talking about. We haven't yet heard that much in terms of weakness in the States until this recent kind of data deluge that we've seen. And suddenly that rate cut, that concern around any sort of electoral influence from the Fed has kind of dissipated in the markets, which I thought was an interesting turn of events.
And we're going to get University of Michigan consumer sentiment data today, aren't we? Which is interesting because Bloomberg Economics, looking back at the GDP data, saying, OK, so consumer spending improved last quarter, but it was softer than the second half of 2023. So telling quite a nuanced story, I suppose, around the ever-important US consumer. So those are a couple of the data points that we're going to be looking out for a little bit later on today then, Lizzie. And moving through, I mean, into this open, though, there's going to be a lot of stocks on the move, as you highlighted, some from the luxury sector that could change our thinking, really, or at least at the margin, reset expectations, at least at the very high end.
Yeah, I mean, Hermes, as I say, is kind of an anomaly within that luxury picture at the higher end. But yeah, it ends the week of really difficult times for the likes of LVMH and Kering throughout the week. Did I mispronounce Kering there? Did I suddenly make it French?
Maybe.
But yeah, no, we keep an eye on those. Also, the Ray-Ban maker will be interesting after we saw the news about Meta actually looking to take a stake and looks to be one of the big movers at the open. It is, of course, the world's biggest maker of eyewear. I thought it was funny that Emily Chang's interview with Mark Zuckerberg very much showed he's in his fashion era now. So an interesting story on the terminal.
All roads lead to the fashion conversation this morning then. In terms of the futures picture, we will be back with the market open. Futures are pointing tentatively higher, but perhaps decreasingly so. Nasdaq futures up 0.5%, E-minis up 0.4%. We'll be back with the European Open, though, shortly. This is Bloomberg. A few minutes to go until the opening trade here in Europe. Let's have a look at where we are in terms of the markets and the handover from the United States then yesterday. This is the big drop we saw in European stocks yesterday at the start of trade. That was very much driven by some of the disappointment around the earnings stories. We managed to actually claw back some of that territory, perhaps helped by the start of US trading. Fed rate expectations and expectations of cuts may be assisting there. But then the US session faded. So you might have thought we'd see a bit of negativity at the start of trade. But whether it's a reset on luxury from Hermes or some other driver, it seems, Kriti, that European futures set to go just a little bit higher at the start.
Yeah, marginally higher. And you're seeing a little bit of that positivity show up in U.S. futures as well. It simply feels like, given perhaps the reaction to what you just showed up on the chart. But when you talk about a marginal reaction, I mean it is marginal. Only higher by 0.1% on Eurostar 50 futures. Slight outperformance in the UK. We'll call it 0.2%. But you are still seeing weakness in the DAX, down about 0.2% here. That is spreading into the FTSE MIB, the IBEX, some slight outperformance in France. But even though we are seeing on the surface, Lizzie, a little bit of green on screen weakness in some of the kind of other markets.
Well, let me tell you why that may be, because, of course, we did have the Mercedes earnings and the car maker seeing earnings plummet, as I say, 28% in the second quarter, 19% in the second quarter, because of that weakness in China and because you had EV sales on the back foot. But we also have to watch out for Hermes weathering the slowdown in luxury better than its peers because of the wealthiest of wealthy clients buying its Birkins. NatWest also want to watch boosting its full-year revenue after net interest income dropped less than analysts estimated. But also, EssilorLuxottica, got to watch that. The world's biggest maker of eyewear, the Ray-Ban maker, of course, confirming last night that it's interested Meta in taking a stake. But Anna, we're nearly at the open.
Okay, yes, absolutely. So we'll watch that developing story around EssilorLuxottica and Meta's intentions. We have those stocks to watch then, very much in focus as we get to the start of European trade for this Friday morning. Kriti was taking us through the futures. She's right, it was very marginal, really, wasn't it, which side we were going to head on these markets. But what we've got so far looks pretty mixed. The IBEX is down by 0.4%, a little more volatile, a little more responsive, perhaps, to news flow than some of the other markets. The FTSE is pretty flat this morning. It's interesting to think about the recent drivers of activity, the slowdown in China, what that's been doing to basic resources, the slowdown in China and what that's been doing to the luxury sector, all of that weighing. And there is a China theme running through the auto sector as well. So it does feel as if perhaps that China link and the pull of the Chinese economy into Europe, that is having an increasing impact this quarter round when it comes to the earnings stories, and we're sort of paying the price for some of that. For the moment then, we see a bit of outperformance on the London market. We are not open yet on the DAX or on the CAC, but we do have a little bit of upside in London. Elsewhere, some downdraft, and so we're pretty flat overall then, Kriti. Let's take a bit of a deeper dive into what's on the move so far.
Yeah, it looks like the winners of yesterday are today's losers and vice versa. The idea here is seeing that Unilever, for example, outperformed the market yesterday. Today, it is not only one of your kind of drops, but it also is your biggest weight on the FTSE 100. But to the upside, you are seeing a lot of the energy names, your Shells, BPs, Rio even getting in on the trade, Glencore, we even have Anglo-American. I'll throw Total in there as well because it is pushing the upside on the stock 600, although it's kind of flirting with that line of what's actually moving. So it feels like energy really in focus this morning, Lizzie.
Yeah, really, it's a mixed picture in the stock 600. If you break the sectoral basket down, roughly half in positive territory. Energy, as you say, leading the gains, higher more than 1% this morning. But bottom of the basket, you have food, beverages and tobacco, telecoms, tech. Just looking at some of those individual movers that we were talking about earlier, and we spoke to Man Group, of course. Those shares higher 2.7% off the back of their earnings. Rightmove higher 2.3%. Hermes, we've been expecting an outperformance, 1.6% higher this morning. We await Mercedes, we await NatWest, but Holcim, we spoke to them as well, lower 2.4% at the open. We still await Vontobel, despite our conversation.
So some of those stocks not open yet. We do have an opening trade, though, on Eni, the Italian energy business, and they've raised their full-year guidance, profit beating estimates. So even though we don't have much of a move in the oil price, that is enough to lift that whole sector, it would seem. And we are seeing strength there. Second quarter earnings beating. Strong upstream performance seems to be the story. Higher crude prices offset weakness in the gas and refining margins. So it's an interesting one because we're going to move into next week with some more news coming through from that sector. So we'll keep an eye on that. But Eni to the upside this morning, up by around 3%.
I'm just zeroing in on those negative movers there. Your Nestle and Unilever are your worst performers. That's a really interesting trade. Lizzie, you were doing that interview with Unilever yesterday. So to see a complete turnaround in the markets. I also mentioned, speaking of turnarounds, when you look at the stock 600, and I'm going to talk about the kind of underperformance in the IBEX as well, because that's where you're seeing a lot of the pain this morning as we await the opening trades on the DAX and the CAC Iran as well. Banks seem to be the weight across the board. And this is a really interesting dynamic, given you're seeing that show up in the FTSE 100 as well, where you see the likes of Standard Chartered, for example, SocGen as well, and even Lloyd's, all lower this morning, Anna.
Yeah, absolutely. So a real focus on the banking sector. We had Lloyd's numbers yesterday, NatWest numbers out this morning. Let's pivot to the autos because, again, we've had plenty of earnings stories to digest. Yesterday with the likes of Renault and Stellantis, both really weighing on European markets. Today we got Mercedes-Benz out with their numbers, cutting their margin outlook after EV and China sales dropped. Let's get the latest details from Bloomberg's Oliver Crook, who has been following the auto space, of course, from Germany. Ollie, good morning. Mercedes earnings. Take us through some of the detail here. Again, it's another story of China weakness.
Yeah, that's right, Anna. And listen, we had their volume figures out aloud. They pre-released those down about 6%. The real question with Mercedes, because they don't really do the volume play, they're trying to play on margins. They're willing to sacrifice a bit of volume in the sort of for margin. Those margins came in at 10.2%. That was more or less in line. But when you look at their revenue figures, EBIT, net profit, they were all down and down hard. Revenue was down 4%, EBIT down 19%, net profit down 16%. But we should say, Anna, that was from fairly reduced expectations. Those were actually beats compared to what the market had been anticipating. So we were sort of looking at going into the market open. We also got their outlook. They confirmed their guidance. They adjusted their return on sales, their margin, so they lowered that just a little bit. It was supposed to be be between 10 and 12%. They adjusted that down to 10 and 11%. They still see weakness in China. They still see caution in China. They still have a lot of caution around the question of global trade. But Anna, in the scheme of sort of earnings we got out of the auto sector this week on really bad numbers and really bad market reactions, not such a bad reaction in the market here so far, down 1.75% in the early trade here for Mercedes.
Okay, crucial context there, Ollie. Just talk to us about the EV transition as well and how that impacts Mercedes.
Yeah, well, I mean, it will impact everybody a lot in sort of going forward for these sort of months and years to come. But really the focus has been moving for these auto sectors really across the board in terms of kind of their sales right now, right? Let's take a look at some of the movers across the auto sector that we had yesterday, where we had Stellantis down about 9%. They had their worst day since 2021. Renault closed down 7%, was down as much as 14%. And Ford, guys, Ford overnight down 18%. We're talking about the Ford Motor Company losing almost a fifth of its value just on the earnings out yesterday. That is the biggest move that we saw on Ford since the financial crisis. And to kind of put it into context for all of us, we also spoke to the Stellantis CEO yesterday. Have a listen to what he had to say.
The automakers are under pressure. The auto industry is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil.
So listen, we're talking about years to come here from Carlos Tavares. What I think is interesting is that actually nothing has changed on the broad story for the auto sector, but this is really feeling like the quarter where the rubber is hitting the road. The delay in EV sales, the competition from China, the weak market within China, and you're really seeing that illustrated. And the bottom line is, guys, it is a crowded space, a crowded market where the demand is just not there.
Bloomberg's Oliver Crook, we thank you so much for walking us through that Mercedes story. Of course, he has been monitoring the auto space quite significantly as it weighs broadly on the DAX as well. I should just mention we are getting the opening prices out of NatWest. Those shares higher by 7%. We're going to dive in those market dynamics shortly. But another one of the outperformers in this session is Hermes, which is interesting, kind of fighting the grain again, or going against the grain, I should say, when it comes to the luxury space. I want to dive more into the story. Andrea Felstead from Bloomberg Opinion joins us right here around set. Andrea, how are they weathering this storm in a sector that no one has really seemed to manage well, except for the maker of the Birkins?
Well, there's two things going on. They have the Birkin bag, the Kelly bags, which everybody wants and which, there are long waiting lists for. Because they're so high priced, they sell to, the very affluent. So they've got those two things going on. When demand goes down, because they have those long waiting lists, they can simply work through those lists of customers that want them. So it makes them very resilient. But they haven't been immune from the pressures. The silk, the ties and silk scarves, which are typically a way for less affluent middle-class customers to buy into the brand, they're down, as are watches. So, yes, they have outperformed, but not immune from the industry pressures.
I know Tom McKenzie's a fan of an Hermes tie, but let me ask you about the China picture. Is it as bad for Hermes as it has been for the other luxury names reporting this week?
They do say that the sector that includes China is not as strong as the others. Again, it will be, hot brand, more affluent customers. It will be more insulated, but I don't think it will escape the pressure on China.
So that's the earnings stories that we've been dealing with this week. There's other news, Andrea, in the luxury space, and that is around the Olympics, because LVMH, and I know you've been writing about this, the LVMH is creative partner to the Olympics, unprecedented, you say, intermingling of sport and luxury. Are we set to see, yes, a lot of sport over the next 2 years, but also a lot of LVMH?
We will see a lot of LVMH, definitely. I mean, they're going to be everywhere. They're making the medals, the outfits for the French team. One of the most interesting things, when the medals are presented at all of the medal ceremonies, they'll be on an LVMH tray. They'll be on a Louis Vuitton tray. In the check, the damier check, which is one of the most, iconic patterns. And the idea is everyone's watching the Olympics, one of the few events that lots of people watch together. Whatever your background, you may be watching the Olympics. And, you might not be in the market for a bag or a wallet today, but then when you are, you think, I want a bag, I want a card holder. Oh, yeah, I remember seeing that check at the Olympics. And you go and buy it.
I can't say I've ever paid any attention to the thing that the medals are presented on, but now I will, thanks to Andrea. Thank you.
the platforms. You know, if I like enough, I might even just get one built just for the set, just so we have one to stand on as well.
To award our medals.
Yes, just to get through a show, we get it. Andrea Felstead from Bloomberg Opinion, we thank you so much for walking us through that. Let's get a quick check on the sensational six as well, because if it is a question of the heavyweights, remember, this is where you've seen a lot of the movement as well. Novo Nordisk, for example, I'm just going to go left to right here, is actually in the green. Remember, it was one of your underperformers in yesterday's session, as was ASML. LVMH really flat. I'm not going to say that's going to call that outperformance here. Nestle is what's catching my eye, though, down 1.8%. Remember, in yesterday's session, you did see Nestle take a beating. It looks like that beating continues this morning. It's a little bit of a mixed picture when we talk about the sensational six. Let's get a quick check on some of the other stocks on the move. Lizzie Burden, over to you.
Well, let's get back to NatWest, Kriti, because those shares are up 8.4% this morning off the back of their earnings. They dropped about 7 a.m., boosting its forecast for the full-year revenue after that net interest income dropped less than analysts had expected in the second quarter. We also had that scoop from our colleague Ellen Milligan about the preference by the UK Chancellor Rachel Reeves to lean towards offloading towards institutional investors these shares post-financial crisis, of course, rather than the retail market. And it seems that investors are liking the whole package this morning. But let's take a look as well at Eni. Those shares up more than 3% this morning. Still, and it's because it increased its full-year profit guidance earlier. You've had, of course, European energy companies contending with competing winds. You've had, on the one hand, the weak fuel demand, so falling refining margins. You've also had lower natural gas prices. But then, on the other hand, of course, you've had this positive effect of higher crude prices because of these OPEC plus supply cuts. So, Eni there, higher 3.3%. But let's just take a look at the Ray-Ban maker, finally. EssilorLuxottica, higher more than 6% earlier, but paring a bit of those gains now to 5.4%. It is off the back of the confirmation last night that Meta is potentially interested in taking a stake. Of course, they've had this years-long partnership over their smart glasses, and it looks like that's going to be strengthened even more. Investors liking that this morning. Anna.
Lizzie, thanks for that. Lizzie Burden with an update, of course, on the stocks on the move this morning. Coming up, we take a look at the latest moves in currency markets. Jane Foley joins us. We've seen a lot of activity around the yen of late. Also, the yuan, very topical this week, given what's happening in the US election and what pressure that might put on Chinese policymakers. A lot to discuss then with Head of FX Strategy at Rabobank, Jane Foley. That's next. This is Bloomberg.
Welcome back to the opening trade. We're about 15 minutes into the session. We are seeing a little bit of a mixed story in equities, but I want to take a moment and talk about what's going on in this FX market, because you are seeing, I'm going to call it a very technical term, some wonky moves in this market, especially when you look at dollar yen here. 153 handles where we're at, just shy of 154. The strength in the yen has been pretty substantial. When you look at some of the other European currencies as well, you are seeing strength. 128.60 on cable, 108 handle still on euro dollar, and even dollar yuan is getting very interesting, because some would say there is a little bit of a Trump trade situation, a little bit of some unexpected rate cuts over in China. Luckily for us, we've got someone to cover it all. Jane Foley joins us this morning, Head of FX Strategy at Rabobank. Jane, no pressure. We'll just talk about the entire world with you in a couple of minutes. Let's start with the yen, though, because I'm confused at the move that we're seeing. I want to say 30 days ago, we were talking about 162, 163 on dollar yen. I'm looking at a 153 handle right now, and a move that's really kind of accelerated in really just the last couple of sessions. What are we attributing that to? Is that hedging, positioning? Is it as simple as anticipation of a hike next week? How would you view that?
You know, I honestly think, given the immense, huge move that we've seen in the last few days, that this is really a lot of speculators all rushing for the doors all at the same time. Because if you look at some of the themes for this year, for the G10 FX market, a lot of it was, oh, you know, the yen is going to be that funding currency. It almost doesn't matter, even if the Bank of Japan were to hike interest rates, the moves are going to be so small that it's still going to be, you know, there's still going to be carry trades and the yen's going to be the funding currency. There was such a huge weight of the consensus in that trade that I think when it started to turn on the back of the intervention, on the back of the dollar weakening in July, as the Fed September interest rate hike became more likely, then the market just started to run for the exits all at the same time. But now that we've had that big initial clearing out of positions, the market is going to start to look back to those fundamentals. And yes, we do have on July the 31st that Bank of Japan meeting, but actually the majority of sort of seasoned economists are not expecting a hike. And so that might mean that we get a little bit, perhaps a little bit of an upside in dollar yen, a little bit of that rush to the exits sort of ending for a little while at least now.
You talked about the carry trade as well, the yen being kind of that funding currency. We've seen that carry trade kind of, I don't want to say come in and out, but just fade just a little bit after some of the elections that we saw in Mexico, arguably the Brazilian real as well. The Trump trade is some kind of thrown in there a little bit. We'll put that to the side for a second. But if we're talking about cuts from the Fed, we talk about positioning for the dollar and then a hike from the yen. Walk us through the carry trade du jour of the next 6 months.
Well, I think the carry trade will still be there. I think perhaps it's not so quite straightforward as you've been pointing out over the next few months, but it has been the big theme of this year for foreign exchange. Interest rate differentials, they have been the big theme. Even if we look at July, for instance, we had, the Trump trade, a lot of people, thinking at that point, before Biden stepped aside, that Trump was going to win that election. The Trump trade was on. We were thinking, well, that's going to be inflationary. That means that the Fed isn't going to cut interest rates so much. And yet the dollar was weakening because it was focused really on September and the chances of an interest rate hike. So it's the interest rate differentials really have dominated. Now, I don't think that theme can be swept aside quickly, even though the politics are seeping through.
Isn't that a positioning story, though? Isn't that just an unwind of dollar longs?
Well, that's all part of it, too. So, but certainly I don't think it's totally over. But I think it has changed, and I think people might be willing to go into those trades and be a little bit more cautious, be perhaps a bit more nimble, willing to get out. But I think politics, clearly, as we go into November, is going to become the overriding theme.
You bait me with the Trump trade, Jane, but I want to turn to the UK politics and the strength that we've been seeing in the pound, this world-beating run of gains, and you've been a cheerleader for the pound for some time. I wonder if it is because we've got this newfound experience of political stability, or whether actually it's starting to reflect actual strength.
Well, one thing that I would say about the pound is that, yes, it is now the best performing G10 currency in the year to date. Yes, it was the second best performing G10 currency last year too, but it's not a strong currency. So if you look at it in terms of just, what the models are saying, or if you just look in terms of long-term averages against the euro and the dollar, it's still not a strong currency. And one way that I like to look at sterling is that, in September 2022, which was, of course, the Liz Truss time, cable hit an all-time low, an all-time low ever. So what I like to think about sterling, it's a currency that's picking itself up onto its feet, based and really prompted really by a much more political, stable outlook last year as well as this year compared with what was before. And I think if we do get good news in terms of investment flows, investor confidence, perhaps first of all, and perhaps a better news in terms of the consumer at some point, then I think sterling can build upon those gains. But one thing that worries me right now is that positioning data is beginning to show that the market is long of sterling. So it's a little bit more complicated to be or to call for those gains when everybody is sort of already on that trade.
Well, yeah, because I do wonder whether it's going to lose steam in the second half when we haven't talked about the Bank of England. Yesterday we saw, the bets piling into the BOE starting to cut soon, possibly next week. Where does that leave you on the pound?
Well, again, I think it's very complicated against the US dollar, partly because of what you've just been saying and partly because of the US political uncertainty too. I think that perhaps we can look for a little bit more clarity against the euro. But you know what? The euro is the third best performing G10 currency this year. The story of euro resilience, I think, this year has been really quite remarkable when you think about the weakness of the German economy and when you think about what's going on in French politics. I don't think we've heard the end of those stories yet. I think the euro could still come towards, a few bumps in the road. But I do think that if we maintain this view that investment growth may outperform in the UK, because it's been really, investment growth has been quite static for quite a long time in the UK, then sterling could have an edge. And again, partly because historically, sterling is still fairly soft against the euro.
Yeah, the euro strength, despite the fact we saw that ECB cut before the Fed. I mean, maybe people not thinking they diverged too much. Let me take us back to the dollar conversation, because you were saying that the Trump trade had been applied because of the polling, and that led people to conclude that would be inflationary, that there would be tariffs would mean more inflation and the Fed doesn't cut rates so much. But then how do you balance that against the rhetoric from President Trump, from his vice president nominee? How do you balance the rhetoric? Does the rhetoric matter? Because they talk about wanting a weaker dollar. Is that of no importance?
It is obviously important. But I think we've got to look at the US economy as being such a credible economy. The central bank, the Federal Reserve, has been a credible central bank. Because if we don't, we're looking at a situation like Erdogan in Turkey, when Erdogan, put his own people into the central bank lost its independence, and, interest rates were cut, inflation was huge. We've got to assume that that cannot happen in the US.
Yeah.
And if we assume that that cannot happen in the US, and that political interference is going to be very limited in terms of what the Federal Reserve can do, then we've got to assume that it's going to be fundamentals that are going to drive the dollar. And if we're talking about a more protectionist US economy, if we're talking about the possibility of Trump tax cuts, then we've got to consider that inflation in the US is going to be a little bit more worrisome than it would be otherwise, and that the Federal Reserve won't be able to cut interest rates that much.
And if you're thinking about the other side of a dollar trade, I mean, many options are available, but the mind goes to China and the world's second largest economy. If Trump did want a weaker dollar, that might mean we'd have to see a stronger yuan, and the Chinese are not going to be minded to create that environment right now, given all the headwinds that face the Chinese economy.
Well, that's right, but, in a way, clearly the situation is extremely complex, and anything to do with trade and investment flows is very complex. But in some respects, it boils down, to a very simple outlook, which is the market right now is not confident about investing in China. The market is not confident about Chinese growth, given the rhetoric between the US and China. And I would stress, this isn't all about Trump. We've seen in the Biden administration no real moves to move back to, the freer trade environment that we had. We've seen Janet Yellen basically explain to us that this isn't about just free trade. It's about free trade when we have one partner cheating and therefore sort of ruining the environment for everybody. So if the US remain, irrespective of the president, wary about that relationship with China, investors are going to be wary about investment in China. And that probably means a prolonged weakness of the economy in China, as we've been seeing this year, which means that there is continued potential pressure on the Chinese renminbi, and which the Chinese authorities will try and fight.
How much of, I'm going to bring right back to the Trump trade here, how much of the Trump trade is going to show up in some of that EM currencies? The idea here that you might have weakness in the peso, weakness in the Brazilian real, and again, bring it full circle to that carry trade. Does the Trump trade get in the way of the carry trade, or does it help it?
I think it depends in what you're talking, which country you're talking about.
Take your pick.
So, for instance, if you look at Mexico, Mexico is now the biggest single country importer to the US for goods over and above China. So from that point of view, there are countries that are going to benefit from the stresses between the US and China. India, for instance, is trying to reposition itself. Countries like Canada, even Ireland, can all benefit from the animosity, shall we say, between the US and China. So there will be changes in terms of growth, production, investment as a function of the US trade. And to some extent, actually, we could bring this straight back to Japan. Because Japan is trying to position itself as a collaborator to the US in terms of defense. And we had the Prime Minister of Japan in the US, in Washington, in the spring, trying to get investment. We've seen an awful lot of investment reforms in Japan. And that could actually mean that in 2 years' time, we're going to look back at the position of the yen now and say, my God, that was cheap. If those trades sort of work, or that investment reform works.
OK, Jane, thanks so much for joining us this morning. Jane Foley, Head of FX Strategy at Rabobank. Coming up, we will take a closer look at the markets as we close out the week with Maria Vasilou, Head of Pictet Research Institute. We'll focus on what we've learned this week. We'll also take a sort of step back and look at some of the broader investment research themes that Pictet has been dealing with. More on that shortly. This is Bloomberg.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, there seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in employment.
Former New York Fed President William Dudley and, of course, Bloomberg Opinion columnist giving his view on why the Federal Reserve has no reason to wait to cut rates. We're joined now for a little bit more insight here. Maria Vasilou, head of Pictet Research Institute, joins us around the table this morning. Maria, a pleasure to have you on the program. It's an interesting take that Bill Dudley has there, where he's basically saying the time for rate cuts is now. And that seems to be something that the market has come around to, the prospect of a September rate cut. Whereas previously they were saying, the election risk in November really takes that off the table. Why do you think that transition has happened?
Well, the market is very susceptible to pricing rate cuts. This is really what the market wants to see. However, I'm not really convinced that the Fed should rush to cut rates. First of all, the economy is still relatively strong. We see the recent data really not showing any collapse in growth. At the same time, we don't know what the next president is going to do in terms of fiscal policy. Yeah. And the Fed, of course, has a dual mandate, but I think between the two mandates, they need to emphasize the inflation mandate. And some of the policies that the next president may follow could be inflationary. So they need to be careful there.
Which is why I find this so interesting, because we talk about, I'm just going to go with the two presumptive nominees here. If it is indeed Kamala Harris, and she continues that infrastructure investment story from President Biden, that's going to increase costs. If you have a tariff story on the Trump side, also going to increase costs. To your point, inflation on both sides. And yet it's not showing up in the data. When does that show up? Is that a story that's still 12 to 18 months away?
I think there is a lot of uncertainty about the economic policy of the two candidates, but we have seen how sticky inflation has been, and also at the same time we have important structural changes in the world economy that are also likely to continue to be inflationary. So I don't think it's to the interest of the Fed to cut rates now and have to raise rates again 6 months from now.
Is it the same story for the Bank of England, or do you kind of share this fear that if they don't get on with it now, actually they might miss the window?
Well, the Bank of England is a little bit in a different situation because of the weakness in the economy in the UK. In the US, we're not seeing that level of weakness that should really force the hand of the Fed.
I kind of wonder more broadly whether, and I know central bankers don't like to wade into the fiscal story, the political story, but whether the fiscal conversation needs to be had more within that monetary debate.
I have been a proponent of the idea that there has to be a coordination between fiscal and monetary policy, especially given the role that the Fed and the major central banks are playing since the Great Recession because of the holdings of government debt they have, and effectively they are marginal buyers of their country's debt.
Maria, can I take a little bit of a step back from the sort of day-to-day news and focus in on a couple of the topics that you cover with your research? Because actually the first one of these really does link into the Fed conversation, and that's around US debt sustainability. When we came into this year, there was a lot of focus on, well, we're going to have a lot of supply, and that's going to be one of the things that guides Treasury markets, and it has been a factor, but there have been other factors, and a lot of the issuance we watch and people in the market say, oh, well, lots of people bought it and it was well covered. What do you think we need to watch on debt sustainability that the market doesn't pay enough attention to?
What we need to focus on is how interrelated the world is and how much the rest of the world will have to lose by, any crisis in U.S. debt. When you look at the discussions that happen around U.S. debt in the media, it's very much in the framework of how we would analyze debt sustainability for a small open economy or for an emerging market. But the case of of the U.S. is very, very different. And the rest of the world is highly intertwined with the U.S. And therefore, the U.S. is effectively the quintessential too big to fail case. So there is a lot of fear-mongering around the debt sustainability in the U.S. But the situation is much more nuanced, and we're having a report coming out in the next couple of weeks really analyzing this story.
So is this what you're referencing, the interconnections then? Is this Japanese and Chinese holdings of US Treasuries? Is that the interconnectedness you're talking about?
It's not just Chinese and Japanese holdings. In fact, Chinese holdings have gone down over time, but it's also the holdings of other assets that the rest of the world has in the U.S., and particularly equities. The rest of the world owns about 40% of U.S. equities if you account also for private holdings, private equities, and so on. And that will be greatly affected if there is a crisis in the U.S. debt.
And it feels like, but there's also I'm going to play doomsday here for a second. Forgive me. Let's say it's first, second week of January. We have that deficit ceiling. The new president, whoever that may be, won't be inaugurated at that point. So the economic policies won't even begin to take shape or early on. What happens? We hit the debt ceiling. There isn't a reaction. If 2011 is any indication, you see a bid into American assets anyway. What's the worst case scenario here?
Well, we may have some, turmoil in the markets, but I think the official sector, both in the U.S. and the rest of the world, has a very high incentive to step in and save the day and really provide a floor to those assets.
When you're a big picture thinker, what makes you hopeful?
What makes me, before becoming hopeful, I think it's important to understand all the forces that are shaping our world. There are a lot of things that are changing on the geopolitical front, on the structure of the world economy, the disruption of technology and AI, the demographics. So I think before we become hopeful, we need to understand the environment in which we will be operating going forward, and also what it means for the way we approach investments. And that's exactly what the Institute aims to do.
Yes, and thinking about those big picture themes, and you mentioned demographics, we get this lesson from Japan about what an ageing population looks like. We have fertility rates in Europe and in parts of the emerging world that are actually coming down really, really quickly. What does that mean for economic models going forward then, Maria? Do we need to rethink the models that we operate on? Is it all going to be about productivity and technology?
Exactly. We need to rethink the models we're working with, but also the way we invest going forward, the opportunities that are likely to be ahead of us, but also the risks. And the interconnectivity of demographics, for example, with technology, what it means for growth rates going forward, what it means for inflation, what it means for debt sustainability. So there are a lot of things that we need to rethink. For instance, the concept of emerging markets. This is a very old concept. Does this group of countries still make sense in the way we approach them, or do we need to rethink about them? And so this is really what we aim to do at the Institute, and hopefully we'll have the opportunity to discuss some of our reports in another opportunity.
You've had a couple of buzzwords there: inflation, debt sustainability, demographics, and they all, to me, come right back to the Japanese story. And I think right now is a really crucial time to ask that question, because historically Japan, of course, has been the leader and the roadmap almost for monetary policy and arguably fiscal policy around the world. But you're seeing what happens when the demographics do get to that point. To what extent is this some sort of warning? And I'm going to argue this on the debt front as well, because GDP for Japan isn't looking that great either in terms of the debt story. What lessons are we learning right now from Japan that apply to the States, given the size of the States?
This is the topic of one of our reports that will be coming out. And exactly, we view Japan as the case study for the rest of the world. What is happening in Japan, we're going to see it also in Europe and in other parts of the world. So suddenly there will be important lessons lessons. But I think it's also important to think in terms of the interplay between technology and demographics, and also different sources of energy that exist, and what that means for the mix of growth and inflation going forward.
Thank you very much, Maria. Thanks for joining us. Really good to speak to you. Maria Vassilou, head of Pictet Research Institute, and hopefully we can touch more on some of those bigger themes, those long-term themes in the future. Let's have a quick look at where we are on the markets, though, at the moment, this Friday. What are the stocks that are gaining? And we have a strong lineup for you here. Let's start with Drax in the energy business. Pre-tax profits coming in ahead of estimates. We've also got, I think that is NatWest in their second year, up by 7%. What does it mean that the sale of the remaining stake by the government might go to institutions? Does that mean it doesn't go at such a discount? And they upgraded their guidance. So those two drivers there. EssilorLuxottica, we watched news flow around Meta, and Eni in focus as well, also raising guidance there. Let's have a look at the losers as well. Capgemini cutting its full-year revenue forecast. ThyssenKrupp in focus, falling after a warning from that business. BASF profits falling after the chemicals giant faces a drop in prices. And we've got Mercedes also in focus, walking back its outlook around EVs and China. Coming up on the programme, the Olympic Games are set to light up Paris with the opening ceremony due to take place later today. We'll speak to the CEO of the French food giant Danone. That conversation coming up shortly with a big sponsor of the Games. That exclusive interview is next. This is Bloomberg.
We have different recipes. 500 recipe has been made since 2 years for the athlete. We are there to help them to win a medal, you know.
The Olympics is a net positive, you know, the world has its eyes on the country, and business-wise, I think it can only be positive.
Everyone is coming to Paris for the Olympics, so of course it's a unique opportunity to meet. I think as CEOs and sponsors of the Olympics, we are used to discussing, but everyone wants to have fun and celebrate the Olympics.
We know that more tickets now, there's a record that have been broken here, because more tickets have been sold than in Atlanta, which was the highest world record. So we can say this morning that we've already have achieved a world record.
So those were some of the French business leaders we've been speaking to on the build-up to the Paris Olympics, which begin later today. The unconventional opening ceremony is set to take place along the Seine, with more than 10,000 athletes due to take part in the Games across 19 days of competition. Millions of spectators expected to attend. And Bloomberg's Caroline Conan is with us in Paris, joined by one of the sponsors.
One of the big sponsors, actually, one of the big French sponsors, and it is Danone, one of the biggest food company in the world. I'm very happy to be joined by the CEO, Antoine de Saint-Affrique.
Good morning.
Good morning. So you're a big sponsor of these games. Obviously, there's been a very good mood in the lead up to these games over the past few days. But just now, we've learned that there is a big disruption at the SNCF train lines. Is someone trying to waste the party?
Well, I mean, it's obviously extremely sad that some people are trying to take the Olympics hostage or trying to pop the party. It will not happen. Actually, if you look at the mood in Paris, if you look at the beauty of the site, if you look at the enthusiasm of our people, I mean, the party is on. So sad attempt, unacceptable attempt, but the party will go on, and it's going to be a fantastic party.
We're about 10 hours from the opening ceremony. Are you going to attend the opening ceremony?
I will be in the opening ceremony, and I'm very, very much looking forward to it.
Obviously, you're the CEO of Danone. Eating healthily is very important when you're an athlete. As a sponsor, you're going to provide fresh dairy, plant-based products to athletes. You're also going to have dairy takeaway kiosks in the different venues of the Olympic sites. Can you tell us which products are going to benefit the most, which products you are trying to put forward internationally?
Well, obviously, first and foremost, it's the Danone brand. I mean, it's telling the story about Danone. It's telling the story about what Danone is doing. Danone is doing health through food to as many people as possible, and doing it in an absolutely yummy way. So you'll see right next door in Gare Saint-Lazare a kiosk where people going off the train can experiment yogurts. You'll see in the Olympic Village products for the athletes, and even for the French athletes, some very, very special products that we have developed to make sure that they win some gold medals.
Oh, so you do have reserved some products for the French athletes so they can win. What kind of products are they?
So, I mean, we've worked with athletes, actually. We've developed 23 new products for the Olympics. We have developed, in particular, protein-based products that help muscular recuperation. We work very close with INSEP, which is National Institute for Sport. We work very close with our partners, Sportive. And indeed, we have some products, especially for the French sportsmen and sportwomen.
You're talking about high-protein yogurts. You have said that your high-protein yogurts actually are getting a boost from people on anti-obesity drugs. We've seen the recent success of these weight loss drugs, but you're not marketing those exactly as anti-obesity products. Why that? Is that bad for the image?
No, it's not a question of good or bad for the image. I mean, what we do, the heart of what we do is gut health. I mean, yogurt are good for guts. I mean, it's about the microbiome. It's about everything you can do with probiotics, prebiotics, postbiotics. And we are one of the world experts in protein. So we help muscular mass, muscular recovery. We help gut health. That's what we do for a living. And obviously it works in synergies with some of the major trends, but it goes beyond those major trends.
But you don't want to be necessarily associated with this idea of anti-obesity products, because potentially the side effects of these treatments, that could backfire.
Well, I'm not sure that's really the point. I mean, our products are very complementary to the anti-obesity product. They are healthy products. I think 89% of our product have a 3.5 or more health star rating. So we have one of the healthiest portfolio in the world. Our products are helping you digest, take care of your guts, take care of your muscle. So they are the perfect complementary to people that are using those kinds of products, but it doesn't limit to those products.
Are you expecting a boost in sales on those specific products because of the Olympic Games, because of being associated as a sponsor to these games?
Well, the first reason for us to be a sponsor of the Olympic was, I mean, it is Paris, these Olympics that are healthy and sustainable. We are an iconic French company. We're a company that is about health through food, which is about sustainability. So there was an obvious match. So the first boost that we expect is really our Danoners being extremely proud of what we are doing. Then obviously it's about the image of the Danone brand. It's about people experiencing how great our products are, how tasty they are. So I hope to convince as many people as possible that we have fantastic product, have them try, have them test. Yes, of course. I mean, we will participate to the 13 million meals that are going to be distributed in the Olympics. You're going to see us all over the city. I mean, you see us with incredible yogurt bars in the station. You see us with Alpro bars in a number of places. You see, and I saw yesterday on the internet, some pictures of athletes eating our protein products. So it's, I mean, yes, obviously it's very good for our business. It's very good for our image. It's very good for the Danoners.
13 million meals served during those games to 15,000 athletes who are actually going to sail down the river tonight for the opening ceremony. This is the short-term impact that we're going to see. Obviously, you're in quiet period, you report earnings next week, but in the longer term, some economists actually say that the lasting impact of the games for businesses could last for up to 10 years after the games. Is that going to be a lasting impact for up to 10 years?
We certainly hope so. I mean, obviously an impact in France, where our brand is very well known and very visible, but an impact throughout the world. I mean, making sure that the Danone brand is known for what it is, making sure also that we keep shining. What is fantastic with the Olympics is obviously, I mean, the Danoners from all around the world have been involved. We had torch bearers in the Danone team. But in each and every of the countries, you had local teams taking ownership of the games, either helping the local Olympics team or getting involved with the Olympics. So you have a resonance that goes way beyond France.
Are you planning an acquisition in the health sector somewhere soon in Europe or in the US?
Well, as you know, we've acquired not long ago in the US a small business in the field of enteral nutrition, which is also something we do. And we are a company that also does medical nutrition. We regularly look at the market and at things that are relevant to our business, both from a strategic standpoint and obviously from a financial and economic standpoint.
Finally, we are just a few hours away from this opening ceremony. Did you practice sports when you were younger? And if you were competing in one of the Olympic Games, which one would it be?
So I've been a pretty good skier and I've been doing competition in sailing. But if I have to pick one today, it's obviously Rugby 7. We are very close and we support Antoine Dupont, I mean, one of the best players, if not the best player in the world. He played an absolutely fantastic game yesterday against Argentina. I hope he will bring the first gold medal for France.
Great, Rugby 7, perhaps the first gold medal for France. That was the Danone CEO, Antoine de Saint-Affrique, from Paris, just a few hours from these games.
Caroline, I'm going to have to ask you that question the next time I see you. I feel like you're kind of maybe a winner in the breakdancing category. Bloomberg's Caroline Conan speaking exclusively with the CEO of Danone live from Paris ahead of the Olympic Games. Of course, I have more interviews ahead of the opening ceremony there with the city's accommodation very much in the spotlight. We'll speak to the deputy CEO of French hospitality company Aker. That exclusive interview coming up in the next hour at about 9:10 a.m. UK time. Now, look, the Olympics are very exciting from a tourism perspective, but let's talk about the money behind this, because in addition to some of the excitement around the sponsorships that Caroline has really outlined, you have seen the likes of other hospitality companies, hotels, Air France, KLM, for example, starting to actually take hits on their bottom line because they're worried that what's supposed to be a tourism attraction is actually doing the opposite.
Yeah, absolutely. And we saw from Hermes, yes, their numbers have gone down well with the market this morning, but they did say that the Olympics isn't necessarily a positive in their home market. So there is that sense that when you're as big as Paris, you know, what are you set to gain from hosting the Olympics? So we'll see how that one develops. Difficult to get the kind of in-the-moment data, but as it comes through, worth lingering for a moment on what Caroline was talking about there, about disruption we've seen to the French railways, because we do understand that coordinated malicious acts have been targeted at various TGV lines, the fast train lines in France. This is according to the French transport minister. We've got live pictures, I think, coming through of Gare de Montparnasse, so lots of those trying to get around France, either getting away from Paris if they're not keen on the Olympics, or maybe other parts of France. In the run-up to the Olympic Games, that could be difficult. We're seeing as many as, I think it was 800,000 people being affected by this.
As reported by AFP, that number. But you say that the economic benefit isn't necessarily yet there. We do have a boost to it from our food editor, Kate Crader. She's recommended lots of restaurants in Paris, the best places to eat if you'd like to alleviate that problem over the weekend.
Excellent. So that's something to look out for if you're going to be in Paris. I think you're taking a trip there.
I am. I'm going to do some live reporting. You know, it's very, very exciting. I'm going to check out one of the games as well.
Will you be watching breakdancing?
I will not. I just learned this.
Kiteboarding?
In the last 24 hours, I learned that there were new categories, and I'm really bummed about it. But what I will be watching is tennis, and I'm very excited about that. There are some really great players, and it's going to be a good time, I hope.
Excellent. I'm off to work out what kiteboarding is. And I'm really excited about the opening ceremony and the games. We'll keep watching it from all angles.
Rumor has it Celine Dion might be returning to the stage in these Paris Olympics. Rumor. We don't actually know.
Okay, that's it for the opening trade. European equity markets bringing us back down to earth. Stock 600 up by 0.3%, though, digesting some of the earnings. A slightly better complexion to those earnings stories this morning, maybe at the margin. US futures also pointing higher this morning. Have a good Friday, everybody. The Pulse is next. This is Bloomberg.